Good morning, good afternoon. So this video will be on the weekly review for this week's trading. That is this first week of July. So we'll start with the dollar. So as you can see, from the dollar, we took out these relative equal lows the previous year's July. That's last year's July's trading, and created this bullish order block, and price traced back down inside of it during the last week of December's trading, and we had this one up in price action, and dollar kept on being bullish, targeting these relative equal highs and trying to fill this sell side imbalance, buy side inefficiency, which is resting here. During April's trading, we noted that what we had here is a high resistance liquidity on signature here. This back and forth price action here, it will be preventing price to have a smooth transition for higher prices. So this was expected in price action for the dollar. So price dropped lower, and we've been ranging on the dollar ever since. We had this weekly BC high, and here we have this weekly BC low. So we're going to be focused inside of this range, this fair value gap, inside of this imbalance. So after price rallied higher here, we had this imbalance here, and this imbalance is of interest when expecting a range bound price action like this. So the higher time frame PDRA, which is of interest in this week's trading, is this weekly BCs. So we had price one up above it, took out the previous last week's trading, took out the previous weekly high. So price is now interested in taking out previous weekly's low, because we are not expecting higher prices for the dollar because of this high resistance liquidity run. We are expecting, when you have a high resistance liquidity run like this, you have signatures like this, price will keep on purging sell side continuously. Price will keep seeking a purge in sell side. This is most likely because liquidity by the big money has not been well engineered. Let's put it that way. It's their interest, the interest of large funds are not in the market. So you can see the participation of big money inside of the market. So that is why we've been having this back and forth price action. And if you are a forex trader, the dollar pairs will be almost impossible to read. It will be hard to read. So this is when you look at the courses. So you can write this in your journal if you're a forex trader. Every time the dollar goes into a consolidation, or every time you're anticipating a consolidation in the dollar, the courses, that is the EURGPB, the EURGPY, any course, any exotic cross pairs, there will be better delivery of price in those pairs. So Let's continue. So we had a run during this week's trading going lower, targeting this previous weekly's lows, and our general liquidity for the dollar is this the midpoint of this imbalance. Yeah, this midpoint of this imbalance, this is our general liquidity for lower prices. But this is not me indicating the dollar has made a top and the dollar is trying to go lower. This is the current draw on liquidity as prices expecting lower prices. We'll make a forecast on the dollar for this going into next week's trading. But first, let's discuss this. Let's check the daily time frame. So this is the weekly time frame PDRA, the BC, and this was the price action. You see this high resistance liquidity one we had here, it is synonymous with the one previously shown on the weekly time frame. This is what I'm talking about. So this is a factor in price action. When you have a high resistance liquidity one like this, high resistance liquidity one signature like this, also appearing in the directly subordinate time frame. So this back and forth price action now is a high resistance liquidity one, even though you clearly have buy side liquidity resting above here. Prices unwilling, prices shy of getting above those highs because of this resistance, because price is experiencing resistance here. Last week's trading, we traded above the previous weekly's highs. When you have a liquidity rate of a previous weekly high or a previous daily high or a previous session high, generally you expect a form of short-term reversal in price. So this is one of the reasons why we're bearish in the dollar, because we already took out the previous weekly's highs for last week's trading, and now price is interested in lower prices short term, not lower prices for a long term, because we have a liquidity purge here. The market's purged, the algorithm purged out sell side liquidity here and rallied higher. So this down close candle is a bullish order block. So this down close candle is also synonymous, is also correlating with this midpoint of that weekly, the consequent encroachment of the weekly discount week. So we are expecting a discount in the dollar. So this equilibrium point of that week, this consequent encroachment of that weekly week, this is fair value for the dollar. So we would want to see the dollar drop lower after Monday's trading, after the 1st of July's trading. We want to see the dollar drop lower, join towards this midpoint, seeking fair value, which is below this weekly BC low. And from the group, we noted this sell side. We noted sell side liquidity, which was resting here. So on the Telegram, I prompted you to note this relative equal lows, which was resting below here, and you had buy side liquidity, which was taken above here. So you had price take out buy side and now currently seeking sell side liquidity. So going into this week's trading, every time price rallies higher, we're expecting that to be a manipulation leg higher. So like the power of three we just discussed, it also works on the weekly time frame. Price valid above the Monday's trading opening price to manipulate for manipulation, and after which, because we are expecting lower prices, we're expecting price to draw to the weekly BC low and this consequent encroachment of the weekly discount week. So on Monday's trading, price made these highs here and dropped lower. Then we had a rally in price action to take out this buy side liquidity resting here, because early shorts that entered on Monday's trading, it will be purged, they will be taken out of the market. So when their position is neutralized, their sales, their buy side liquidity, their buy stops will now be used as smart money's entry for selling, which occurred here. So when this occurred here, when we had this drop lower in price, this quick drop lower in price, we do not expect this imbalance to be filled. Why is that? Why don't we expect this imbalance to be filled? Because from this rally higher in price action, price left imbalances, this volume imbalance, this fair value gap, and also this fair value gap. So this price action now is lacking in sell side delivery. This from Monday's trading only had buy side delivery here, so it is lacking in sell side delivery. So when we had this quick sell side delivery, this now became a balanced price range. That is from this range to this range is now a balanced price range. So we do not want to see price trade above it. So you had this bearish breaker here. Why is this bearish breaker, and how is this bearish breaker? Because this was the down close candle that was used to make these sellers, the sellers that sold here and placed their stop orders above here, this was the candle that solidified, that made their hopes high. So this breaker candle broke their expectation in price. It broke their will. So because their will, what they are expecting, their will they are trying to enforce in price action is expecting lower prices. So this breaker broke that will. So price neutralized them here. So this now is the bearish breaker, and price trades above here and then drop lower, trades just to the weak of the breaker, this low of the breaker, and we had price drop lower here. And this week's trading, it was an eventful, packed week. Eventful not in the sense of a fully tradable week, eventful in the sense of there will be too many manipulation in price, because we had FOMC on Wednesday's trading and we also had the 4th of July celebration on Thursday's trading. So on Thursday was a holiday, and on Friday, being today's trading, we had NFP release. We have the NFP numbers that will be released. So because we're expecting lower prices and we are still expecting a choppy dollar going lower, you'll be nimble in price if you are to trade the dollar pairs. For the US 500, which is the CFD for the ES, that is the S&P, Going into this week's trading, that is this first week of July week, we went into the week expecting higher price action. That is from the Telegram. We noted the liquidity was purged, or where liquidity was being purged, and where liquidity was being swept. And from the video on order flow, when order flow is bullish, we noted that when order flow is bullish, you get liquidity being purged on the sell side and being swept on the buy side. Synonymously, up close candles become violated. So up close candles will be changed into breaker blocks, and down close candles will be respected as a bullish order block. Now, on the weekly time frame, this is where we got our narrative from going into this week, that price will and should remain bullish. So zooming in, as you can see, after price rallied higher here and left this fair value gap here, this BC, we had this institutional order flow entry due inside of here. This is an institutional order flow entry due. We'll talk about this later. I keep postponing it because we need to get some things cleared during this mentorship before we start understanding institutional order flows. Because to understand institutional order flow, you must first understand the basic mechanics of how the algorithm books price, and also the order flow, actual order flow, not institutional order flow. There is a slight difference between the two of them. The institutional order flow is algorithmic, while the order flow, it is based on the programs being executed. The institutional order flow is like how the algorithm uses these PD arrays, these tools, these signatures in price to facilitate order flow. So back to this. So we had this rally in price, then price traded down inside of this institutional order flow. So when price does this, as price, we just expect a quick rally in price going higher, with little to no retracement, because price has already done this retracement here, and also this retracement which traded inside of at the low of this candle, which is the high of this fair value gap. Now we add this breakaway gap. This was a breakaway gap from the week of 10th of June. So we had this breakaway gap. Now, if order flow is bullish, and institutional order flow is bullish, a breakaway gap, when you see a breakaway gap in price action, you expect an explosive move in price action. So this is this is a breakaway gap. So when you see a breakaway gap in price action, ICT, the analogy used for a breakaway gap is like it's like rocket fuel. When you put the way the combustion engine of a rocket fuel works, so the breakaway gap is seen as that combustion engine that will facilitate explosive move in price action to a one-sided direction. So when you have a breakaway gap on the BC side of the market, when you have a breakaway gap on this side of the market like this, you do not expect a retracement lower inside of it. Now, from the economic calendar, if you use whichever economic calendar you make use of, I personally use the Forex Factory. So if you use the Forex Factory and you toggle you filter everything to medium or higher impact news event, and also using the US dollar, only the US dollar as the currency of concern, you will note that this week we had multiple red folders news On Monday's trading, we had a high impact news. On Tuesday's trading, we had a high impact news. Then on Wednesday's trading, we had FOMC minutes. We had a high impact news in the morning, and we also had a high impact. We also had FOMC minutes by 2 p.m. on Wednesday's trading. Then on Thursday's trading, we had the July 4th celebration, which is the Independence Day celebration. And on Friday, being today's trading, we also have NFP, which is a high impact folder. So, with all of these high impact folders, coupled with the narrative being presented in price action, with this institutional order flow entry due, which is this last significant retracement in price. So, you do not expect any retracement in price going higher. That means any gap that is being formed in price after this retracement have traded inside of this institutional order flow, you will note that as a breakaway gap. Using this as for explanation, we'll talk about the breakaway gap in more details later on. So, because from the weekly time frame, we are not expecting price to trade inside of this breakaway gap, where only any retracement in price will be a short-term retracement in price action. So going down to let's see the daily. On the daily time frame, because we had this breakaway gap, this is the breakaway gap found on the weekly time frame. Now on the daily time frame, you had this fair value gap, this BC. Sorry, let's take this off. We had this daily BCI, and just below it we had the daily BC low. So we had this imbalance which price was ranging inside of, and if you observe during when we had this imbalance here which price was ranging inside of, the dollar was also ranging. The dollar went into a range bound price action for the last week of June's trading. So because of that, you expect a range in price action, but a range higher. A range has the direction in which it is ranging towards to, even though it tries to hide its signature that it is doing nothing. It is currently moving sideways. It is moving either in a higher, either ranging higher or ranging lower. So we had this range, price was ranging higher. If you toggle your chart to line chart, this is what you see. You see when price made this low here on Monday's trading, the significant volume was on the upside. So you see, it was, if you are looking solely at the candlesticks bar, you will be seeing wicks. Those wicks are illusions. When the candlesticks is becoming too problematic and anxiety inducing, you should switch to a line chart to see the algorithm clearer. The line chart delivers the actual move of price, the actual move that's being represented in price action. The candlesticks deliver the open, the high, the low, and the close of that time interval, but the line chart gives you a clear directional move on where the algorithm is currently printing price to, on what program is currently being executed. So anytime you feel lost while using the candlesticks to read price action, switch momentarily to the line chart, because the line chart will make things clearer to you. So let's go back to our candlesticks. Back to the candlesticks. From what we just gathered now from the line chart, we gather that it is ranging higher, and these candlesticks are illusions, they are manipulations. So we do not expect those after this down close candle and price at this other down this candle, when this candle was below here on Monday's trading, July 1st trading, everybody will be expecting lower prices. They will expect this to be a top, that price has taken out this liquidity. Yeah, that price has taken out this liquidity and price is now interested in lower prices. This will be their notion, this will be their narrative in price. But from the video on order flow, the second video, the part 2 of order flow, we noted that when order flow is significantly bullish, every time price raises a pool of buy side liquidity, that is a liquidity sweep. And a liquidity sweep is a pool of liquidity that price will still be interested in trading to and through. And when price has purged sell side liquidity, price will not be interested in going lower again, especially when you implement time in it. A high probability liquidity purge takes place within a Q zone. I'm going to delineate each day by a vertical line. So here we had Monday's trading, and here we had Tuesday's trading. This is Wednesday's trading, and here we had Thursday's trading, and finally today being Friday's trading. And from the weekly time frame, from the going into this week's trading, we noted that breakaway gap, which means we're expecting a significantly higher price. That means there should be little to no retracement going into this week's trading. So with that out the way, this is what we noted. So on Monday's trading, I prompted the group on this as a liquidity sweep, and you were all told to study this liquidity sweep. And if you did that, that means you benefited from it in one way or the other. Let's make this thicker. So because liquidity was swept on the upside, if you identify a sweep in liquidity earlier in price action, it will be easier for you to anticipate purge of sell side liquidity. After price has swept a pool of liquidity which is in line with the order flow for the higher time frame order flow, you anticipate price purging out sell side liquidity. This is when your anticipatory skills comes into play. Now, because you are anticipating a purge of sell side liquidity, Monday's trading we had a high news trading, but because typically Monday's trading is usually to get the week's sentiment, to get trader sentiment for the week, to engineer sentiment for the week. So most times it is better to use Monday's trading to understand the week's narrative, the weekly narrative, the narrative that will be in play for the whole week. So we had purge of sell side liquidity after a sweep of buy side liquidity. So after this liquidity purge on Monday's trading, Tuesday's trading, as you can see, look at the price levels. Look at this. Look at these prices. The low of this candle, this low of Monday's trading candle is 5,444.2, and the low of this candle is 5,444.2. This is not support and resistance. This is liquidity being purged on the sell side, and because it has been purged, you do not expect price to trade below this candle that purged out liquidity. Price is allowed to trade inside of the wick, of that candle, but price should not trade below this candle. If it trades below this candle, that is price indicating to you that liquidity now is being swept on the sell side. Does that make sense? So we add this rally higher, we add this breakaway gap, and also this breakaway gap. When you have breakaway gaps like this being represented in price action, this is price indicating to you that indeed we are significantly bullish for the week. That means the week will be a significantly bullish week. That means you will expect little to no retracement in price action. And as you can see, there was almost no retracement. Price kept on pushing higher. And we only had a liquidity pool taking a year. This was the only significant retracement to reversal we had here. All of this was a retracement down to this other block here. Price valued higher and left this imbalance on field. And also this imbalance on field. So you want to spend, as smart money traders, you want to spend a significant amount of your time on the weekly time frame, on the higher time frames, because that is where you will get enough information. You will get as much information as you would need to go into the week's trading. Do you understand? So you want to spend much time trading, studying the higher time frames, the monthly time frame and the weekly time frame. Then occasionally you go into the daily time frame to get your bias for that day. But when you are studying the weeks, you're trying to understand the weekly order flow and the institutional order flow being represented in price action for that week. The weekly time frame will give you enough information for you to work with. So that is it. Let's check Euro USD. Okay, let's do Euro USD. I've not looked at Forex for a very long while. Price was taking out buy side liquidity here. So buy side here was taken and price dropped lower. So, and this was the bearish order block from the weekly time frame. So here we had this bearish order block. Sell side liquidity was swept here and also swept here. That means every rally should be wanting to come to this low. So this should likely be a manipulation leg. So for the euro, June took out the buy side liquidity from the previous month's high, which is this. Call this X. So price dropped lower and left this volume imbalance here. So these green lines are volume imbalance. So going into this week's trading, we had this last down close candle here, this down close candle before price made this up close candle here. What is this? You take a Fibonacci and you look for the equilibrium of this candle, of this order block. This is the order block now being used in this on the weekly time frame. This is the weekly time frame, and this is the consequent encroachment of the week of this order block. So we note this as CE of discount week order block. Take this off. So price left this liquidity void inside of this, which coincides with this consequent encroachment of this order block here. So you have this liquidity void here, and on Monday's trading we dropped lower on Monday and Tuesday's trading to purge sell side here. So after price purged out, at first price swept buy side liquidity here on Sunday to Monday's trading, going into Monday's London trading. So buyers liquidity was swept on the buy side, and it was purged on the sell side. So when liquidity was purged now on the sell side, respecting higher prices. So this was the business. Tuesday's trading made the low of the week, and price was gravitating to these highs here. But let's see how it goes. We also have these relative equal highs resting above here. So that's all, and I'll talk to you in the next video, and goodbye, good luck, and have a great weekend.